Hello, everybody. Welcome to a live webinar for the next half an hour with me, Willem Knaap, and Gregor Gimmy on the other side, sponsored by ASIF Ventures. So today we're going to talk about an interesting topic, I think, how to sell to a corporate, or why a corporate venture client is more relevant for the success of startups than corporate venture capital. I'm Willem Knaap, and I have approximately 15 years experience commercially and into innovation. I'm one of the co-founders of an investment app called Peaks, peaks.com, where you can invest your spare change. And currently I'm employed at Rabobank and work as their innovation scout. Today my guest, as mentioned, is Gregor Gimmy. He's the co-founder of the BMW StartUp Garage and 27 Pilots. And we will talk about how startups can better sell their solutions to a corporate, and how the venture client model, invented by Gregor at BMW and also with his companions, founding 27 Pilots, enables a corporate to partner and acquire startups faster, thus helping startups to succeed. So, Gregor, could you give a brief introduction of yourself?
Yes, hello and good afternoon. Glad to be on this call. And just about 2 years ago from today, we started 27 Pilots, 3 colleagues from BMW plus myself. We are, so to speak, a spin out of BMW. And what we're doing at 27 Pilots is basically what we did within BMW for other corporates. And that is help them gain competitive advantage through cutting edge startup technologies. And prior to BMW, I worked myself as an entrepreneur in Europe and in Silicon Valley. And prior to being an entrepreneur, I worked in strategy consulting at Roland Berger and IDEO in Silicon Valley too. So I've seen both parts of the world, both Silicon Valley in Europe, but also the world of a corporate and the world of a startup and of an investor. And I think those 3 experiences led me to define and develop the venture client model, which I think kicks ass, and especially in favor of startups that can now I think gain quicker traction and grow faster by engaging with corporate venture clients as opposed to corporate venture capital.
Sounds great, Gregor. Thank you. So if you've been around, you've seen a lot in Europe, but also overseas, and multiple angles as an entrepreneur, as a part of a corporate. So how did you come up with the venture client model?
Well, when I was working at BMW, I started in 2012 in innovation strategy. So that did nothing have to do with startups, but my role was to help with long-term strategy. And what I found at BMW, to my surprise, is what I call the startup gap. So basically that meant there are many problems that could be solved best by startup companies, be it in IT, be it in the car, be it in manufacturing, logistics, but you couldn't find those startups. So what that basically meant that what BMW was working with, not the optimal technology, because they missed startups, so hence the startup gap. But the startup gap was not 5 startups per year, it was more like in the hundreds per year. And when you look at the tool that a corporate would need in order to bring in technology of hundreds of startups on a yearly basis, investment wasn't a choice, because investment per se is not scalable. So I devised a model that allowed BMW to incorporate technologies from startups in a large scale across the entire organization, and with low cost and risk for both parties.
Okay. And what was the biggest problem you had to solve?
Well, the biggest problem from the corporate point of view was speed. And you may all think now, well, the corporate is slow. Well, a corporate, relatively speaking, is actually pretty fast, given looking at the mass of people and the amount of product they are managing. So if you ask a BMW what's important for her, then it would say, well, I got to develop the next car really fast. And if I'm faster, developing the next generation of autonomous driving, or the next mobility service, then I have a competitive edge. So you want to help those guys access technology fast, but also find the technology fast, and very importantly, transfer. So it's not just about scouting and finding that there is a great startup sitting in Silicon Valley, Israel, or in Amsterdam. It's about how can I get this technology from the first touch point into the corporate fast. And into the corporate means that the engineer needs to be able to work and apply this technology so that technology of the startup can work its wonders within a product or within a process of a big corporate. And that speed problem is, I guess, one of the most important problems that we solved through the venture client model.
Okay. And you mentioned competitive advantage as the edge for this model.
Yes.
So how was the talk with, in this case, for example, BMW on their need to work with startups and their goals with that?
Yeah. Well, one of the, let's say, language issues in the corporate or in the corporate world talk about startups is that you always talk about startups as an innovation tool, or you talk about collaborating with startups. And even those terms, they are correct, but they're not really precise, because the goal of a corporate, first of all, is to gain competitive advantage through a startup technology. So it's not only innovation, it's also about getting a faster database, getting a faster logistics process, being able to be faster in HR response to its own employees. So everything that really helps a corporate be more efficient and also be better in terms of its product, that's really what defines competitiveness. So if we position a startup just as an innovation tool, we are really reducing the ability of a corporate to work with startups, because only a few startups really would have solutions for the product itself, but many startups would have solutions for the factory, for logistics, IT, and so on. So what you need to look at as a startup is as an ecosystem from which you can draw competitiveness, meaning cost advantages, but also revenue growth opportunities. And by that, you really make startups a much more important competitive resource than just talking about innovation. The other thing, it's not about how do I collaborate with startup. It's really about how to transfer and how to adopt technology from a startup. Collaboration is always an important part of everything you do within a corporate setting, whether it's with your colleagues or whether it's with other partners. So collaboration is just important. But what really we need to focus on is not how to collaborate, but how to adopt startup technology. And to adopt startup technology, you're looking at really at two big things. One is partnership. You enter a joint venture, you do a co-development, you do a licensing, you integrate the startup in your supply chain. And the second is ownership, M&A at the end of the day. So you have a controlling interest over the startup, and you can basically integrate the whole startup into your ecosystem. And those two big bucket strategies are really the ones that allow you to adopt a startup technology. To get to adoption fast with low risk, that's where the venture client model plays a big role.
So thank you for that. So to be pretty precise, what is the advantage of having a launching customer compared to get an investment from a CVC, for example?
Well, for a startup, when I was a startup, I think it's still true today, you pursue two objectives. If you either want to sell your product or you want to sell your company, right? Especially if you're venture backed, correct? You got to, at some point sell your company, you got to go, or you got to go public, but you always have to sell your product. So you don't start a company to sell your equity. You don't sell your startup to sell a minority stake and to have many investors. When you go public, then obviously, or when you sell the whole company, but then you're selling everything to one investor, and that's kind of part of the deal. So the core objective of an entrepreneur is always, first and foremost, sell your product. Because the first question everybody's asking you when you start a company, or when you want funding, or when you hire employees, or when you just talk about your company, is always, what problem are you solving for what customer, right?
Yeah.
So so the venture client model focuses on buying the product of a startup and not buying the equity of a startup. So it's a very direct way of engaging with a startup, where you don't have to go the extra route towards the investment part. You go directly towards purchasing the product of the startup, and that generates not only revenue, but most importantly, it generates motivation, it generates proof, it generates product market fit. And if that client is a corporate that has a much more stringent deeper analysis process, it's much more difficult to sell to a corporate than maybe to sell to an individual person, correct? Then that's really a very important milestone in for every startup, to add corporates to their list. So and at the end of the day, when with your startup you want to show success, you want to show your list of clients. You don't want to show your list of investors, correct? Because the investors are a function of your clients.
Clear. Thank you for that. Before we continue with the interview, for all the viewers, thank you for watching, still being with us. Really important. You can ask questions at the end. There's some room to ask some questions to Gregor. On the right, as I see, there are a couple of sections, and one of them is called questions. So if you have any questions, please post them in the section called questions, so we can pick up one or multiple questions at a later point. So it's really important for a startup, you mentioned, to get to work with a large corporate get them as a customer. So how do startups know if a corporate is ready to work with them, Gregor?
Well, yeah, that's a very good one. So ideally, what you do is you Google for the corporate name plus venture client, because that tells you that the corporate is open for business, A, and B, it tells you that they actually dedicated resources to make that sales funnel of yours very short, very fair, very effective. So you could probably sell to every corporate, and you would need to find in LinkedIn or on conferences. So who are the guys who could actually buy my product? Which, by the way, is not the CEO. They will never buy your product. It's but then, how do you get actually to the purchase order? How do you get through legal? How do you get to procurement? How do you get to all those barriers that the final end user of your product, the engineer, for example, would also have to go through? So if you want to find a client that's very fast, where your sales funnel is very short, and where you get really excellent feedback, client feedback, not mentoring, but really client feedback. Hey, I used your technology and I think this and this works and this sucks, correct? Then Google for venture client and see which corporate really took the additional step towards getting to it. And it's a little bit like think about you guys looking for a job, right? You're not looking for a job because you have a startup, so you have a job. But if you have a very good education, and we're looking for a job, and you would find a company that doesn't do any type of HR, you would know that you would send the resume there and you probably will never get an answer, correct? Or maybe you get an answer by accident and then you have to go into very, cumbersome legal discussions about your working contract, and then they don't have a career path for you, and you wouldn't know if they, and they would probably make you an offer where they would say, well, why did you work for free for a year here? And then we'll see if we engage with you a long time. So this, I think corporates without a venture client unit, run the risk of establishing a relationship that kind of looks like trying to work with a corporate without an HR department, without any legal and without any, financial incentives around actually entering that relationship.
Okay, but let's say a company has or doesn't have a venture client unit.
Yeah.
How can a startup tell anyway a good from a bad corporate client?
Well, you would first of all you would need to look into the who you be actually working with in this venture client relationship. That's very important. So you don't want to work in a lab in Israel away from the headquarters. You want to work at the headquarters. You want to work with a guy who's using your product and who will ultimately make the decision. That's a very important point. So who is using and who are you interacting with in terms of using your technology? That's very important. The second is what's the depth of the first purchase they're doing, correct? They could go and say, hey, why did you come and show me your product and you do some kind of a beauty contest? Or they could tell you, hey, I'm going to buy some samples of your product, even though it's not ready. We're going to implement it in our real factory, for example, real settings, for example, factory. We're going to use it for 4 months in this machine and this setting. And we're going to generate data to see if your technology really provides the savings that you claim it does provide. So the pilot project, the definition of the pilot project to really give you a chance to demonstrate that your technology works in a real setting, this is also very important. Thirdly, you don't enter into any kind of IP conflict, correct? So there's no contract that says, hey, give me your IP and do this and that, because we all know that you have to retain your IP and the corporate wants to retain their IP, correct? There needs to be a payment for what you do. That's extremely important. If they're not paying for using your technology, they're not a client, correct? It's just a demo. And that doesn't count. So what you want to show to your employees and to your investors and to your future employees is, hey, here's a purchase order, correct? Here's the corporate, they're buying from me. And it may not be a huge amount at the beginning, but that never is the case. So if BMW would buy new technology from, let's say, SAP, they wouldn't go in there and hand over a $50 million check in the beginning either. They would also start with the first small purchase, test it out, see if it works, and from there on increase the purchasing amount once they see that this technology really works. So a few points that I hope give you an indication about this.
Yeah, so what you state is in what you found, the venture client model holds that a company has in this case like BMW or Bosch, a separate venture client unit, which a start or scale up can sell their product. So there's no equity going from left to right. Mm-hmm. There is no partnership contract. It's the corporate, or in this case, for example, BMW is becoming one of their launching customers of the start or scale up. So what are some of the biggest pitfalls for startups of selling to a corporate?
Well, let's say there are a lot of pitfalls, I think, in the sales process. Once you close a sale and you made sure that the contract and the condition of the sales are right, from here on it's pretty obvious. But some of the pitfalls, for example, is to think that a corporate venture capitalist can generate sales. So what we've seen also in research with INSEAD Business School is that many startups approach a corporate venture capitalist basically as a sales channel, correct? I go to the CVC and I think that those guys now help me. And obviously that's what they claim they do, and some do it better and some do it worse, but in any event, it's always a delay, correct? Because you first have to go through the investment funnel and then you have to go in the purchasing funnel. So you're looking into two funnels, so you're looking easily at over a year, maybe sometimes 2 years, in order to really get the purchase closed. So that's a very important pitfall. Do not approach a CVC expecting for them to do your sales work, or even if they promise that they are the sales funnel, look for the venture client within the corporate, and you can approach the client directly. So don't have to go through this extra route across the over the CVC. The other thing, it's always said that you need C-level support. And I want to stress that C-level is not making a purchase decision of a startup product. They may do an M&A decision, but not a purchase decision. So when the C-level goes and travels around and talks at fancy VC dinners or conferences, what they do is they collect a list of startups and they just send it around the company, and then they are hands off, correct? They send it around to the engineers or whoever and say, hey, I met those startups, have a look, correct? And that's it. But so the C-level would not have the expertise nor the power to make a purchase decision. It's really the engineers who need to use the technology who will really push for that acquisition. And then very importantly, they still have to go through purchasing and legal. So the CEO cannot command purchasing and legal to just sign a contract. This is not possible, at least not in Europe, and probably not in the United States. And that's very important because, you have a lot of compliance issues. You have to go through hoops and loops in order to get your product into a corporate. So the CEO cannot jump those because that person would get into deep trouble. So that's another pitfall when you seek the interaction with the final user. And it's good to know the CEO. That always helps, but it's not the person who's going to buy your product.
Thank you for sharing that, and also sharing some of your learning points in the last years. I'm just curious. Can you mention some results of your work and the venture client model and units you have built?
Well, from the corporate perspective, what we did is, for example, we measured how long it would take BMW prior to having a venture client unit from the first point of contact with the startup to the actual first purchase order. And that was somewhere around 25 months. And I think the German government, it's also, a big company that buys technology. I think they had a research saying that it takes them 7 years to buy a new piece of technology. So with the
that's a slight difference.
But 2 years, I mean, that's a long time for everybody, And and so with the venture client unit installed, on average, we reduce this under 6 months. And we have cases where it's way below 6 months, but on average, so we're looking at a significant speeding up of the time it takes to actually transfer a startup technology. So that would be one metric. There are some others, but I think what I would like to keep have the listeners remember is speed. Get your product into the corporate fast, and from the corporate point of view, get the technology from the startup into your corporate fast, because every day counts when you have a technology at your hand that can improve your product or processes. Correct.
Great. So thank you for that. What's the best advice you can give to startups, Gregor, right now?
Well, focus on first of all, focus on the value that your technology generates at the corporate. So go there with numbers and tell them, if you use my technology, you're going to save XYZ millions per year, or you're going to make XYZ per year. And work on that business case, because the corporate will do that business case from their side anyway, correct? There's no way they will bring a technology in or acquire your company without calculating some kind of, what does it mean for my cost? What does it mean for my growth and revenue? So go in there and have those numbers prepared. And maybe a second number you should throw on the table is, the amount of funding that you have, because many of you have a lot of funding. And you'd be surprised to see that in many cases you have more funding than the corporate client who may be using your product. And instead of arguing for, hey, I'm leaner or nicer or more beautiful or whatever, just go there and say, what's your budget to develop and to solve that problem? And we've seen at BMW many times that startups come with tens of millions, where the budget for that specific tiny problem, within the overall $7 billion budget that, for example, BMW would have for R&D, those specific problems that you guys, startups, are good at, there's a big difference in amount of cash that would be available inside and out. And that's the same, by the way, for Google or Apple. So, because if not, they wouldn't be buying and acquiring startup companies, correct? So startups have the IP and have the cash to reach a development level that's hard to match for corporate, for all those tiny problems they have. So if you go with those two numbers into a corporate, I think you have a much better chance of being listened and being adopted. Okay, great. I have one last question for you, and then I have a couple of questions from the audience that I will ask you. So I ask you to the best advice to startups
But with your experience, what's your best advice you can give to corporates in this case?
Well, the best advice maybe I would give to corporates is that, if you want to benefit from the iPhone, you don't buy an Apple share, you buy the iPhone. So if you want to benefit strategically from the startup, buy the product. Buying the equity doesn't give you access to the startup technology. It more often than not, is a barrier to accessing this technology, because now you're a shareholder. Now you're under very special shareholder rights, and you're delaying access through that investment to the technology, to all the engineers who are waiting for you to close the round, and you don't close the round. And so, if you want to benefit strategically from a startup, just go out and buy its product. Don't. And then if you like it, buy the whole company.
So become a customer. If you like it, buy the damn company. Thank you for your insights. I have a question here from Ivano Petzotta. Thank you for that. So the question is, at what point in the startup life cycle is it interesting for corporates to partner up?
Well, you should have a functional prototype, and you should also have some institutional investment. That's very important. So the institutional investment, given that startups won't have a balance sheet and sales and financial stability, having a VC investor as a backer is good for A, because the corporate sees that you can scale through that money, and B, that there is an outside party who could vet and look into the things that a corporate is not specialized in, which is in is how good is a team, for example, right? So the corporate would always focus on how interesting is the technology. I want to use this technology, so there needs to be a functional prototype. And if there is an investor, even though if it's a small investor, if it's an institutional investor, that gives the corporate another, check mark in terms of gaining trust into establishing a relationship with that startup.
Yeah, and is there a specific? Thank you. Is there a specific amount of sales or numbers startups should show, or is that too specific per startup, per solution, per case? So what's your opinion on that?
It depends very much on where you're selling into. So if you are let's say, efficiency tool for manufacturing, then you're probably looking into a much faster rollout. If you're providing next generation fuel cell technology, catalyzers or whatever for automotive industry, then you're looking more into the next 5, 10, 15 years. So look at you always need to look in relative to where your product is being used, if that's ready to be launched into the end user's status, and you just make your decision based upon that.
Okay, and I have a couple of questions. The latest question coming in is, what is the incentive for companies like BMW to use the products of these startups? So Tom McDonald asked the question. He states it might result in loss of efficiency as employees have to get used to the products, and these might not be as useful as they may seem on the surface. Is speed to market such a big benefit to outweigh the risks? Thank you for the question.
Well, there's only one reason for a corporate to engage with a startup. It's because they have a solution nobody else has. And that solution is so important that you're entering as a higher risk. You're more risk friendly because that outside resource, a startup, has a solution that you don't have internally or they don't have anywhere else. So that's all there is to it, correct? And now what you have to do is you basically focus on making that relationship very low risk. So if you see that a startup has a solution that nobody else has to a problem of yours, then what you don't want to do in the first step is go in, for example, with a large investment, because if the solution doesn't work, once you used it, now you're still stuck with the equity, correct? And what you do now, correct? The solution doesn't work, but you're still stuck with the equity. So that generates additional cost, and the money is you can't just go out to Wall Street and sell that stock again, correct? So that's why that venture client relationship is very easy, because you just purchase a small amount of those products. If they work, great, you purchase more. And if it doesn't work, then you ask the startup to come back, if a little later as they iterated and improved on their product, and it's a win-win for both.
Okay, thank you for that. A quick question: does BMW ask for exclusivity?
The venture client in the venture client relationship, there's no exclusivity agreement.
Okay,
and
clear.
And that's. But obviously, every client can make their own decisions, and that's just a negotiation that you have to go through. And by the way, that will be a negotiation that you will have to do all your life, correct?
And how can you persuade people within the company to open up to work with startups?
Well, because if you approach BMW and you have a chemistry that allows the battery to charge in 3 minutes, everybody will roll out the red carpet for you, correct? So it's really you guys. I mean, if you start a company, that's not because you're looking for a job, that's because you have a solution to a painful problem. So just communicate that painful problem, and you don't have to convince anybody to open things up, because you're saying, hey, I'm solving your headache. Nobody else can solve that. And, here's my solution. And then, everybody will open their arms and work with you, because everybody is looking for solutions.
Great. And one last question, because of the time, sorry for that. I have a few more questions received. Thank you for that. I will try to see if we can answer them after the webinar. So it's about the way 27 Pilots works from Stefano Coco. How does 27 Pilots support the entire process other than putting in contact corporates and startups?
Well, we at 27 Pilots, first of all, establish the internal infrastructure to operate a venture client unit. So what we did within BMW, and that's why it worked, is that the BMW StartUp Garage is an internal entity. It's like the internal team with internal processes and resources to enable that engagement and that quick transfer. And that's really the core of our business at 27 Pilots, to enable and to set up the resources and processes within the corporate to be able to be a good venture client.
Thank you so much, Gregor. 32 minutes. Some people are already checking out. Thank you for this. We will end this webinar. Thank you for being here in the webinar and having told us more about the venture client model, and of course about some results and all your experience. I want to thank ASIF Ventures for the live webinar hosting it today, and afterwards there will be a short recap posted on LinkedIn, so you can watch back a couple of the answers. Thank you so much. Bye.
Thank you very much.